I'm Oliver Sloup with Blue Line Futures coming to you from the Chicago Board of Trade with another episode of Tech Talk. Monday, May 24th, we're revisiting some of the charts that we looked at last week, and I want to kick things off by looking at the July corn contract. Now, last week we talked about the potential bearish head and shoulders formation coming to life, and we're starting to see that play out. As you can see here, we made an attempt at this 670, 680 resistance pocket at the end of last week, but failed. We've kind of peeled back here, not all the way to support, but pretty close in that 640 range. A break and close below this 640 area would potentially trigger some accelerated selling pressure via long liquidation from the funds, which has been a common theme over the last several weeks. We know from Friday's Commitment to Traders report that funds reduced roughly 17,000 additional futures contracts, which drops their net long position into the neighborhood of 295,000 contracts. So break and close below there, and you're probably going to see a lot more of that long liquidation. Now, on the flip side, the bulls could potentially get a breakout above here. And if we do that, that would negate some of the bearish technical patterns that we're seeing develop and potentially invite some new buyers back into the market and squeeze any shorts out of their positions, because right now you've got a lot of technical traders taking a short position here with limited risk, knowing that if we get out above 680, we probably go make another attempt at that $7 handle and potentially retest of those contract highs. So those are some of the levels and risk parameters that we're looking at for this week's trade. Moving over to the soybean market, soybeans broke below this 1575 area last week, and that's where the selling accelerated. We peeled back here to the psychologically significant $15 handle. There's pretty good support all the way down to $14.90 as well. And in this morning's Grain Express, we wrote that if you've been short this market here since that breakdown point, this isn't a bad spot to look at reducing. We wouldn't be surprised to see the market stabilize between $14.90 and $15, maybe even a little bit above, consolidate, and maybe even chop around in a wide 75-cent range. I wouldn't be surprised to see the market retest this breakdown point, and that's going to be the inflection point. Will we be able to chew through that pocket or not? Again, previous support now becomes resistance. So the bears, I think, have a little bit of an advantage on an intermediate term time frame until we see consecutive closes out above 1575. But I would not be shorting here. This is support. This is where you want to be reducing some of that short exposure. Now, moving over to the wheat market, wheat has fallen off a cliff here over the last several weeks. We broke through support. We talked about reducing short exposure in the 670 area last week. We broke below that today, obviously. Tested the 100-day moving average almost to a T. Then kind of springboarded back into this resistance or support pocket, which was previous resistance going back here, and then the breakout point, obviously, right here. So, again, I'm still fairly bearish on Chicago wheat, but this is not the place where you want to be stepping in and shorting the market. We've had a big move lower, temporarily oversold. If we get a relief rally back into this $7 up to the 715 area, I would like to take another stab at the short side with clients with limited risk. Again, it's all about risk parameters. We get back out above 720. That's where you take your medicine and move on. But right now it looks like the bears have pretty firm control of this market. Now, wrapping things up with livestock, we're looking at live cattle. We had a bearish cattle on feed report, relatively bearish cattle on feed report on Friday afternoon. The market opened lower here early this morning, but didn't do much. And we talked about this in our interview today with RFD TV, how we've just been tethered to this 116.75 to 117 area for 5 consecutive sessions. And I pulled up this chart. This is from the last Tech Talk we did. I haven't moved any of these lines. We're still in that wedge formation and right in this significant pocket. We're looking for a breakout or a breakdown. A breakdown potentially takes us back to the low end of the recent range in that 113, 114 area. On the upside, 120. So we are, essentially in the middle of that risk range. So still waiting on a little bit more confirmation on what that move is going to be. We're hopeful it's to the upside. But again, the shot clock is starting to wind down on that June contract, so we're not going to be holding our breath. We're a little bit more optimistic longer term. We've seen slaughter numbers pick up. Hopefully we can see that continue to be a trend, chew through some cattle and get cash to work a little bit higher. But as of recently, it's been a bit of a stick in the mud. So it's kind of a wait and see moment going forward. So this has been Oliver Sloup with Blue Line Futures from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors. Thanks a lot.